Hello, this is Eric Boyce, CEO and Chief Investment Officer at Boyce and Associates Wealth Consulting. Welcome to Charts and Chat for November 3rd of 2024. Well, good to be back with you. Was off last weekend, out of town on the West Coast, visiting clients and going to a short conference. But while I was away, we had the GDP report, and this is the first reading of the third quarter number, which again for the 3 months ended September 30th. You can see here that the actual number came in pretty much in line, maybe slightly below the survey, but I will tell you, and you've heard me talk about this a lot, the Atlanta Fed GDP Now estimate was for about 2.8. And once again, that Atlanta Fed survey has done a brilliant job of forecasting this number. Now, we will get two more revisions of this GDP number before it's deemed final. But as you can see here, looking at that GDP line, this line of best fit going back really a couple of years, you can see that it's kind of like aggregating in that 2.5% to 3% range, with a notable drop in the first quarter. Drop not meaning to say that it was negative, but it was a drop from levels that we've seen heretofore. Now let's talk about the components of that spending, and this gray area is really important because that represents total consumer spending. We're going to talk about that in just a second here, but we also had government spending, which has been a consistent contributor to overall economic growth, although I do feel that this is going to become less so perhaps over the last year, or excuse me, the next year. Business investment was positive, as it has been for the, in much as recent memory, goes back. And then on the downside, we had a little bit of a takeaway here from housing, as well as inventories. We had net inventory declines, and then also trade. And a lot of that has to do with the fact that we've had a very strong US dollar, and we've had imports which have exceeded exports. And you can see that that's been the case for several quarters now. Now, if we go into the consumer number and break that out in between goods and services, you can see here just the aggregate number is as high as it's been since the third quarter or first quarter of 2023. But you can see that both goods and services contributed to the overall growth in consumer spending there. And you can see that that's really been the case for most quarters, with some notable exceptions here. So continuing the theme of overall consumption and consumer spending, we have here for the third quarter real final sales to domestic purchasers. And so this is a quarterly number. This is quarter over quarter. SAR represents a seasonally adjusted annual rate here. And you can see that that number has been actually very consistent over quite some time, over many quarters. And you can see that this latest quarter represented a little bit of a tick up. Again, it's not as basically as tectonic as some of these changes are, but it's been pretty steady. So consumption has been a consistent contributor, as we just saw, into overall economic growth, and that was certainly the case in this last reading here. Another thing that we've been watching has been the economic surprise index. And so this thing ebbs and flows, and you can see that we reached kind of an interim trough here this summer and into August and maybe September. But just lately, we've had some really strong economic surprises. And of course, this reflects in some part, the changing of the opinions that are out there. And of course, people get a little bit more optimistic about the economy. They tend to change their forecasts over time, but I think we had a lot more speculation down here about, are we not keeping up with, the fact that inflation is going down, and are we going to drag ourselves into recession? And there was some of that talk out there, and that's largely waned at this point. Got a couple of data points coming up for you on that end, but the surprises have been entirely positive over the last couple of months, and that tends to feed upon itself. Here we have pending home sales. This is another positive development. This is survey. The September results, as you can see here, were net positive. So, in fact, they were actually much better than the estimate. The estimate was looking for, perhaps another decline and yet more, kind of call it derogatory information. But, the fact that this now on a year-over-year basis, pending home sales being positive, that's really good. We have had some relief on mortgage rates, although here recently with some of the interest rate moves that those have gone back up. But overall, I think people are settling into this longer term notion that affordability is going to be redefined as we know it. Here we have some more data on personal consumption expenditures. This is the PCE consumption data. Again, very consistent with what we saw a couple of charts ago. This is monthly data. You can see survey was looking for about 0.3%. We got 0.4. So again, just strong, consistent consumption data in all of these different measures, and they're calculated, slightly differently and using different criteria, but pretty much they are all falling in line. And you can see here on real consumer spending trends, we've got durable goods, which had a breakout after the pandemic, and is kind of like settled in here, and it continues to move higher. As we move along here, we've got non-durable goods that also recovered, but not to the degree, and you can see that those are moving in that trajectory as well. And then you also see services, which took much longer to recover, and all of those are in an upward trajectory at this point. You have real disposable personal income per capita. And so this is a relative term. So this is measuring basically, disposable income based on the total population. And so we see that this is now exceeding, and has been for some time. And this means that we are basically in an acceleration phase versus where we are. And we're actually above where we were on a trend line pre-pandemic. So again, very positive data as it relates to the consumer, personal savings as a percent of disposable personal income. So this is kind of looking at the opposite end of the lens here. So you've got more income coming in, and then that's being spent, and so you see savings rates are falling a little bit as well. Here we have the PCE price index. This is the PCE measure of inflation. You can see that on a monthly basis came in a little bit less than expected, as did the core. But these both represented an uptick from the prior month, which was totally, basically pretty much expected, based on several factors, several components that feed into PCE that were well understood going into this release. Here we have some employment data. We've got on the left-hand side employment cost index data, which continues to drop. You can see that that's very clearly identified in the overall number. This is a quarter over quarter number. You can see that the actual cost index came in less than expected. We also have the same trend well in evidence here for private industry workers. I think a couple months ago or a couple quarters ago, when this number gave us a bit of a head fake, I said, don't worry, because that tends to, a trend will clearly identify itself over time, and it has. So you can see that employment costs are going down. That's one component of inflation. This is very much good news. And then the labor market, just in looking at it from through different lenses here, we've got initial jobless numbers. We get this information every week. It was actually lower than expected in the last week. And you can see it's really range bound here. And so the labor market, despite some kind of chinks in the armor, I guess, and we see some hiring intentions kind of pulling in a little bit, the overall health of the labor market is relatively strong, even as unemployment rates have moved just a little bit higher. Here we have large company layoff announcements via the Challenger survey, and you can see that For a while, we were worried perhaps that we might see kind of an overall increase over time in these layoff announcements, but really we haven't. So you see big companies that maybe they're not hiring as aggressively as they were, but they're certainly not making, they're not accelerating their layoff announcements. So we have a few more items before we move off of the labor market data. You can see here in BCA Research and Alpine Micro, we've got some data related to the labor force, which we know is moving ever so higher because population is increasing, right? And then participation rate is actually moving a little bit higher. And this has been extremely sluggish. This is on the left-hand scale. So it had been negative. And so you can see here that, this represents a zero line, and we've just about flattened out on labor force participation declines. And so we're getting to a point now where, you're having more people coming back into the labor force, particularly older people. There are more opportunities net. And obviously with an improving economy, people get a little bit more excited, want to get back in the game, so to speak. And then, just as we talked about employment costs, we can see, that wages are continuing to move in a pretty methodical line up here. And so you can see that, the growth on an annualized basis is about 5%. So here we have wages, even though the employment cost index is coming down, we have wages that continue to outpace the rate of inflation. So this is good for consumers. It's good for consumer spending. It's good for the health of the overall consumer. And then, even though, some of those savings rates have come down, the supporting consumption, as long as you have, wage gains that are outpacing inflation, that certainly bodes well for that to continue. Here we have personal savings as a percent of disposable income at 4.6. You can see a little bit of decline there, as we've noted. So this is just another way of looking at it. And perhaps, and I love these long-term trends. You can go back to 2005 and track all this. And so we did have, for quite a while, net savings increases and interrupted a little bit here during the global financial crisis. But if anything, that GFC actually accelerated the rate of savings. And so you can see that we're working to get back up there, but the fact that this is a little bit depressed from pre-pandemic levels suggests that we're spending out of other resources to support consumption. And we're talking about interest rates a little bit earlier, and here we have the overall yield curve. So we've got 1 month maturities here, and you can see, basically in the pink line represents, I'll call it the change from essentially a week ago. And sentiment can change actually fairly quickly. And so you can see that the estimate now probably looking for a 0.25% decrease in short-term, basically overnight rates as the Fed meets next, actually this coming week. It's hard to believe that we're now already in November. But yes, we have an election this week, and we also have a Fed rate meeting. And so rates are expected to come down. So the shortest end of the curve kind of got moved down a little bit. But longer term, we do see those rates moving a little bit higher. And so we get to 3 to 10 years, and we've moved up since a week ago. And that has had a corresponding impact on mortgage rates a little bit because they are indexed to the 10-year. And you can see that, you talk about curve inversion, and it just means that long-term rates are below short-term rates. And that clearly is the case here. But the expectation is these rates are going to come down, and that's why this curve is sloped the way it is. But you look here, and 2-year Treasury rates are clearly below 10-year. So as it is defined, the yield curve from the 2 to 10-year range is not inverted anymore, and then clearly not when you get out into these really longer term maturities. So, talking about various commodities, and we got a big chart on commodities and also gold. But I wanted to first show you, this is just representative. Not all commodities are moving up or moving higher. We have the cattle sub-index here, and you can see that beef prices are really high. We've had some drought conditions overall, and this is something that's persisted actually for quite some time. Beef being one of the things that is much more expensive at the grocery store, as has been orange juice and that's driven by poor crop yields. And there are drivers for all of these things, but, looking at beef prices, particularly heading into the holiday season, are higher certainly than they have been. Here we have more, holistic information on commodities, and you can see that fund flows from investment managers have been really strong. Gold, silver, overall commodities. You see materials, 8 straight weeks of inflows, and you can see obviously the gold and silver, precious metals, getting a lot of money flows here, and that in many respects is driving gold to record levels. And you can see this chart, and it's really profound. Going back to when the gold standard was instituted in the 1920s to basically when it was basically stopped during the Nixon administration here. But you can see gold prices, have been somewhat volatile. It is interesting to see and observe that at times, gold has not acted as it should. When you have declining inflation, that tends to, or disinflation rather, it tends to not be additive to gold prices. But and sometimes it doesn't work as well as a hedge. But clearly, it's been a driver of overall commodity returns over the last year. Take a little bit of extra time and talk about gold and maybe some of the sources of the demand that's helping to drive these prices. And you can see here we've got a couple of charts to show you. Over on this side, we have information from the World Gold Council here, and obviously in the black line you've got gold prices. But what's really interesting is the breakdown of demand for gold, and you can see investment flows were very important here. And so you look at the green level, and that represents interest by central banks, and you can see how that's been a very influential part of that gold price driver. And that's also depicted here. Quarterly central banks, clearly when you get past 2021, the central banks have really been aggressive in their demand for gold. And then, so beyond that, you've got this category which represents net investment. So you have investors that are jumping in with 2 feet and owning more gold. And then this next sliver is the technology use, this little blue line here, and that's pretty consistent. That's pretty stable. That represents, gold connectors in large electronic components and whatnot. And that's gold has been used for that purpose for a long, long time. And then what's really interesting here, and this is a consistent driver, but it ebbs and flows, is jewelry related demand. And then beyond that, you've got basically other demand from over the counter and other sources. But this jewelry demand represents really the lion's share, and that can change. And it has, in some cultures, it has gold takes on much more significance, and it can be somewhat seasonal. But I thought it was really interesting to kind of drive down, as odd as it is, to see gold, be so strong when we have inflation that's really kind of peeling off right now. In fact, we're in disinflation. This has a lot to do with it, as well as the investment side. Central banks, looking at the relationship really between gold and the 10-year. And this is, part of what I was talking about earlier about this disconnect between gold and some of its traditional correlation patterns. And you can see very clearly here, I mean, going back to at least to 2017. So, it's a reasonable amount of data, but there is historically been a pretty reasonable correlation between the inverted 10-year yield and this is real yield too. So again, gold as kind of an inflation hedge is aptly measured against the real yield, which is here. And so obviously we've had some you know some deviations in real yields over the last few years, but then gold prices have continued to move higher, which is reflected on the left-hand scale. And so, as we have, this pattern develop, it's hard to tell where this is going from here. I do think gold has more room to run, but you can see that it is accelerated. And I think that based on the fact that we've got, real yields that are certainly higher because inflation's coming down. That at some point, gold has got to, settle in here a little bit more, and so might give up some of its gain. So here is some more commodities, focusing here on oil. We know the oil prices have been a little bit weak. You can see Brent crude settling in here about 74 dollars and 20 cents for the most part, and then also with the energy markets, we want to measure that against liquidity, and so I'd say this is a very loose correlation. It gives us a lot of data going back to 1990, but I think the R squared or the correlation factor is not going to be terribly strong because there are times where this breaks down a little bit, but by this estimate out of Bloomberg that, with the excess liquidity, again, this is kind of pushing it forward by 9 months, that eventually that extra liquidity is going to push those commodity prices higher, and in particular, in this case, oil prices. Volatility typically rises heading into a presidential election. So this is equity volatility as measured by the VIX. You can see here, we saw some fairly benign volatility, up until about August. And so that has certainly changed. We can see net increases in volatility just as we expect. And oddly enough, we didn't really have a lot of major 1-day moves in the market, which is not, which is typical for a year, right? We haven't had it though, but we've had enough volatility that this overall index has really picked up. Well, we can't have a conversation about the equity market without talking about the Mag 7 and the concentration within the index. And that is clearly depicted here in this chart. So the top 10 stocks in terms of market cap, and S&P 500 is a market cap weighted index. So the top 10 of those stocks represent 37%. You can see that we've never been here before. And and the interesting thing about all of this is that these top 10 are very heavily weighted in technology, although we've got Eli Lilly, Berkshire Hathaway is more of a diversified company, and then obviously JP Morgan's a financial company. But as a result of this technology influence, the S&P 500 acts a little bit more like the NASDAQ. When you look at daily trading patterns, you can see that oftentimes the S&P 500 deviates from the Dow Jones, and it tends to track a little bit more the NASDAQ. So this is definitely not your father's S&P 500 here. And so the other thing we're looking at right now is cash levels. So this is cash as a percent of assets under management, and has clearly fallen below the average here. So people are invested. They're really trying to, I think, in some cases, chase returns. But overall cash levels have really plummeted as of late. Now, looking at returns over the last month, it really begs kind of a sector and style and factor analysis. And these patterns are pretty interesting. So, I talked about volatility picking up, and that's certainly been the case over the last month, or I guess the month of October. The S&P 500 was down not quite 1%, about 9/10%. And but you can see basically, from a sector standpoint, healthcare, materials, real estate. I mean, these are kind of corrections to some of the to some of the upside that we've seen in these categories in prior months. Interestingly enough, you can see technology was down a little bit more than the index, maybe right at 1%, but that was offset by energy prices, which, as we saw, are just beginning to kind of nose up again. And then commercial services and financial energy prices, obviously influenced by geopolitical factors. And so I think that had drove some money flows here. But financials are a real big winner. So that's an interesting development. If we look at factor returns, again, this is just for 1 month, so this is not a trend. I mean, we still are very much behind the dividend growth, factor style of investing. But small caps did not do well. The dividend growth firms did not do well. But interestingly enough, high beta, which are these high flying technology companies, and quality both did poorly. And so really the only thing that did well over the last month was momentum. And you could see growth here was down as well, because in part the S&P, information technology was down as well. But again, these things move around from 1 month to the next, and you have leadership changes, but overall we're seeing greater breadth in the overall market. So if you were expecting a recession, one thing that you would see is a dramatic increase in high yield bond spreads. And you can see here in this chart that was republished in Richard Bernstein's advisors in their newsletter, you can see that these bond spreads tend to blow out when you're heading into a recession, and that's clearly not the case here. And you can see very, very clearly that bond spreads, if anything, are at near historic lows, which is a true sign of confidence in the bond market. Showing a high degree of complacency and really no fear in that regard. Similarly, in the municipal market, you've got high yield muni spreads. These are low rated municipal bonds relative to kind of that risk-free benchmark, and you can see that these levels are also very, very low, and they have been for quite a long time. Got a couple of government debt charts here, and I think this is something that after the election, no matter who gets elected, that we're going to have to contend with this at some point. And when I said earlier that I thought that government spending might be constrained a little bit, obviously one reason why is that interest payments as a percent of overall economic growth are going up just because interest rates are higher. So, we had this long period of time where we had low interest rates, and it was kind of it gave a hall pass to the government to be able to spend more. Well, that's changing, and the interest payments are going up as older issues that are maturing are being replaced with Treasury debt at higher rates. And you can see here also the U.S. debt to GDP, something that's often talked about. And really, I mean, you can look at both the Republicans and Democrats and who's in office, and I'd say that it's pretty agnostic to who's in office. But right now, we've got both sides of the aisle that really don't care about controlling spending. And so as we look at this potentially continuing to move higher, at the same time we've got higher interest rates, that's going to continue to likely move higher. And I think that is a recipe for having government spending be a little bit more constrained and not able to contribute as much to growth in the future as it has in the past. Here we have the U.S. dollar, which I mentioned is very strong. And this is I'm not sure in some respects what to make of this, but the odds of a Republican sweep in this light blue line on this right-hand scale. So right now, Oddly enough, since really over the last month or so, those odds have picked up, and I'm not going to go into those factors because I think we're all ready for this to be over. But what's interesting here is, and I love data patterns, and to see, against, this is June, so it's not a lot of data, but there's just over the last handful of months, we've had this really interesting little correlation where the US dollar has tracked these odds. And so, again, I'm not opining on whether this is going to happen. I'm just saying that, depending on who wins, there could be some unwinding of the strength in the dollar that we've seen lately. And talking about the election, I think it's good to look at past performances of the market during presidential terms. Again, this is Richard Bernstein. He's got his firm has a research piece out that talks about, investing in election cycles, and it's just really good. It's just honestly, it's a reminder of everything that I already know. In many cases, it doesn't matter. I get a lot of questions. Well, what do you think is going to happen with the market? Well, there may be an initial reaction, initial sell-off or buy-in, but really over time, you can see that with very uh, few exceptions, that the markets are going to go up on balance, no matter who's in office. And this was an anomaly because this is during the global financial crisis, which was a systemic dislocation within the fixed income and the overall credit markets. But if you back out that really exogenous event, then you're making money in any administration. And I like to continue that theme. Not only is the stock market doing well, but it's really hard to predict, where all the other investment asset classes are going to wind up because you start with Carter here and you go across to Biden, and you can see, a couple times gold has led in these administrations, and Bush 43. Obviously, we had some wars in there that were being fought and some uncertainties. But in other years, like Reagan and Clinton, we had strong stock performance. We actually had in George H.W. Bush, we had emerging market equities that led. It's very, very interesting how this all plays out. Biden, we've had strong performance out of commodities, and a lot of that has to do with gold. But again, it's just the questions I get, and people want to know what's in my crystal ball. Honestly, I think that we are gonna wind up with a split Congress. So in that last chart, that was the probability of a full sweep. Both chambers of Congress, as well as a presidency, and I don't know that that's the base case. But again, it's very hard to predict where markets are going to go. Now, policy is important, and we'll have to wait and see because policies sometimes will tend to, if you're trying to channel more money to small companies, then small caps might do a little bit better, right? If you're trying to channel more money to to infrastructure investment, which I think is very sorely needed, then maybe you do get, S&P 500 and you get commodities. Uh, and in some cases, you may not get, performance out of the bond market. And oddly enough, sometimes cash performs pretty well in the mix as well. So all this to say that it's going to be much more dependent on policy and much less dependent on whether a Democrat or a Republican occupies the White House. So this is a risk-adjusted return. So this is the S&P 500 one-year return divided by the S&P 500 one-year realized volatility ratio, which I showed you a few slides ago. It's been very low, but it's picked up recently. But so have returns in the S&P 500, and so that risk-adjusted return is actually really high right now. And you can see that this just dot represents basically the average between over the last year here. But this data series goes back to 1990, and the line of best fit, the average for this whole time frame, is very clearly in this range. And so risk-adjusted returns right now, that means the unit of return divided by the amount of risk that you take to get that return, is actually pretty attractive right now. Here we have consensus earnings on the S&P 500. We just really are kind of on the backside of earnings season for the third quarter. You can see that the estimates for the fourth quarter continue to come down, so which I think is very, very healthy, and it actually is very consistent with what we've seen in other quarters, where you head into a quarter and you're really optimistic, and then you get a lot of earnings reports from the prior quarter, and then you tend to ratchet down to be more conservative. And then, I think that these estimates right here, the S&P 500, 500, and $520 is actually a very doable, and it's very achievable. And so the bar is clearly being set lower for the fourth quarter, which sets things up for upside surprises. And you can see where these changes have come into play is in cyclicals, energy, defensive companies. I mean, you've seen kind of a widespread materials. You can see, some of these earnings estimates coming down just because, one, you've got commodity prices that are influencing here in these two categories, and then these might have to do with maybe an expectation of slowing consumer spending. But all this to say that the bar is certainly lower than it was for fourth quarter earnings, which we'll start to get at the beginning of the year, and I think that's a good thing. Margins here are also improving, expected to improve. So even if you've got more conservative earnings estimates, you have estimates for increasing operating margins, and some of this is due to the fact that for companies that have high labor components, that that they're rationalizing, that they're adding more maybe technology, more automation. Eventually, they'll add more AI, and so that's all feeding into this productivity number, which is helping to drive margin estimates higher. Last slide today is something I found was very interesting. Maybe not too surprising that you got the highest 10% of wage earners that 90% of those people had access to a 401k, and 84% were taking advantage of that. So you have very high participation rate for top wage earners. And there's a lot of education. People intuitively get the value of saving. Whereas when you go down to the lowest 10% of earners, and these are people that are probably much more impacted on a cost of living basis from the inflation that we had over the last several years, and less than 40% of them have access to a retirement plan, and even the ones who did, only 20% of them participated. So this is an area where these folks are going to have to rely on Social Security. These folks are going to be able to rely on their savings to a larger degree. So from a socioeconomic standpoint, this is something that I think we're going to have to focus on, in the coming years, as some of these lowest 10% of earners in this particular cohort, they get older and they get closer to an age which would be commonly associated with retirement. So this is going to require education, and it's going to require a lot of, I think, diligent outreach and plan design, and also innovative options that are a lot cheaper for small companies to offer to all employees. That's all we have today. Hope you've enjoyed the chart pack, and we'll be back with you very, very soon. Have a great week.